Today.
Good morning. Happy holidays.
Yes, happy holidays to you as well. Absolutely. Let's go to some of the headlines as we invite people to send their questions in for you over the next little while here today. You've taken a look at sort of summing up a bit of the year that's not quite finished, 2024, and looking forward. But we might just put this week into perspective, if you don't mind, right off the top. There are headlines moving around. We actually just saw a $100 billion investment from SoftBank into the U.S. economy. The president-elect has announced this. Things are moving and shaking long before inauguration.
Yes, and I think this highlights the difference between Trump 2 and Trump 1, right? So back in 2016, I mean, I'm no political strategist, but the thinking was that obviously no one expected him to win, including him. And then he won, and he had to cobble together, a cabinet, and it was sort of, like there wasn't really a plan. And of course, now we have the second Trump term upon us, and it's sort of all gas, no brake. And, Inauguration Day seems like an afterthought because essentially he's already running things and he's making deals left and right. I mean, we saw this with SoftBank. We saw the threat of tariffs on Mexico and Canada, and literally within a day or two, there are meetings with presidents and prime ministers. And so things are shaking, and it creates animal spirits in the markets, of course, because this is a pro-growth agenda. Another headline just came out that, he's already working on slashing regulations. And so the market is paying attention, obviously, for that. We're having a very strong year-end rally. If we can pull up slide 4 for a second, you can just see the flows that are pumping into equity, mutual funds, and ETFs. And of course, the question is, how much of this will be priced in by the time we do have Inauguration Day? And are there unintended consequences of a reaccelerating economy on, for instance, inflation, which obviously has been improving over this year, but it's still at 2.8, 3.3%. So it hasn't quite been put back in the bottle yet. And so if we have another growth wave when the inflation dragon hasn't really been slayed yet, what does that mean for the Fed, for yields, for the term premium, for equity valuation? So there are a bunch of pieces of the puzzle here that are moving parts.
If we went back to the story of rates, there are a number of things to go back to the beginning of the year on, but let's start with rates, where we had just an incredible number of rate cuts priced into the market. That was wrong, but we sort of knew that rate cuts were coming. The inflation probably was in the back of the mind of the Fed still. Is that, I mean, take us back to the beginning of this year, end of last year.
Yeah, so actually, one thing I do to keep myself honest is I look at what I pontificated on a year ago, and so for all of you out there, my Outlook piece, which I wrote yesterday, will be on LinkedIn and X probably in the coming day or so. And so I took stock of, what did I say a year ago? And what I said was, actually, we pull up slide 2. My main sort of takeaway was, and this is a chart of the S&P 500 equal weighted, and of course, Pamela, you and I have been talking about the bullish broadening all year.
Yes.
But a year ago, we were inside that box, and I said, take a look at this chart. Do you want to be long or short this chart? And you see the stair step pattern. And so my conclusion was bullish broadening, which is partly correct in the absolute sense because the market did broaden. 77% of stocks are in uptrends. But on a relative basis, it's still the Mag 7 leading. So we didn't really have the mean reversion on a relative basis, which is probably a good thing because if that happened, the market probably would have been down this year, given how concentrated those stocks are. But that was one of the takeaways. And the other one, as you mentioned, is on the Fed. And I'm trying to find my Fed chart here, slide 21. We had the Fed pivot, of course, at the end of last year, and the Fed went from saying, really not much. It went to saying we're going to cut 3 times in 2024 per the dot plot. Mm-hmm. And actually, the Fed was exactly right because it cut in September, it cut in November, and it's going to cut this week in all likelihood. So the Fed had it perfectly right, but the market, of course, like spoiled children, wanted more. And at the beginning of last year, as you and I had talked about, the market was expecting 7 cuts just in 2024, which is ridiculous. That would only happen in a recession. And so the market had to walk back kind of those lofty expectations, which it has, right? If you look at this chart, the orange line is the forward curve, which has gone from a 2 handle to almost a 4 handle in the course of the last 10 or 11 months. So that's a vast improvement, and I don't really see the Fed going below 4 or even going to 4 because, again, the Fed's going to look at the same tea leaves that we all are, and we see an economy that's resilient, a labor market that's been restored to balance. But then you wonder about, tariffs and immigration policy. What does that do to inflation? If animal spirits are here and we have a whole capital formation cycle happening, the Fed is already kind of walking back from saying, we're not going to just keep easing. We might sort of wait and see. And I think that's the prudent thing to do. So here you see the dots as of September. And my guess is this week those dots will move up because clearly the market has moved up above those dots. And I think the Fed will follow along. And, the good news is that earnings growth in the stock market, go to slide 11. The good news is that if you look at rates as the denominator of a discounted cash flow model, obviously rates matter, right? Because that's how we discount future cash flows, and that gives us the fair value in today's dollars. But earnings by far are the more dominant driver of valuations rather than rates. I mean, rates matter, and they especially matter when they're very, very low because this is sort of the bond convexity translating into equity valuations. But as you can see, the squiggles are moving up and to the right. Earnings growth is likely to be 10% for 2024. Is expected to be about 12% next year. Maybe that comes down a little, but still, the historical average is 6.3%. So getting 10% plus growth is a good thing, and that will help the market withstand fewer rate cuts than it was hoping for.
Now, you mentioned for a long time, and it's always the case, that the earnings have to sort of take over the valuation story. That was from earlier this year, and they did. They just as you said they needed to, and they did. Always earnings, obviously, is going to have to take over the valuation story at some point, but just sort of put it into perspective where we are in that particular piece of the story now for valuations.
Yes. So slide 9, and this is probably my biggest miss a year ago, is that I basically wasn't bullish enough on stocks. I figured that the PE ratio from the October 2022 low until the end of last year had risen 5.5 points, which is quite a bit. And I figured, the valuation in the market had fully discounted the soft landing. And now it would have to be up to earnings to do the heavy lifting as the PE side kind of settled down, and that the baton would be passed. And you can see in this chart that the earnings growth side and the valuation side are often moving in opposite direction. Not always, but usually, and that's because price anticipates earnings. Now, that did not happen this year. We had the help from earnings. They did do a lot of the lifting, but 2/3 of the returns that we've seen, which are almost 30%, came from ongoing multiple expansion. And of course, the Magnificent Seven are very much part of that playbook. But so this is where I got it wrong. I thought it would be a baton pass, and what we instead got was a double-barreled gain of 10% earnings growth and 20% PE expansion.
And the momentum story within all of what you're talking about right there was just sort of that oncoming train that you either have to get on or get out of the way.
Yeah,
basically.
And if I can just show slide 12. And so, this is sort of a favorite pastime for everyone, is when is too much, too much, right? When does the mean reversion set in? When are valuations too high? And my sense has always been that valuations are obviously important. They are a hurdle towards future earnings recognition in terms of buying a portfolio at either a low valuation or a high valuation. But ultimately, they're not going to be the catalyst. It has to come from the earnings side. And so this is the Magnificent Seven, and those are the calendar year earnings squiggles. And you can see they're just still accelerating even after such a monster move. And if we look at the next slide, I'm showing, just for comparison purposes, on the same logarithmic scale, the 493 earnings squiggles and the Mag 7 earnings squiggles. And you can see that fundamentally the performance of the Mag 7 is fully justified, right? Yeah. The PEs are higher, right? The PE on the Mag 7 is 38 times earnings, which is a lot. And the PE on the 493 is 22, which is kind of where the S&P 500 generally is. And so there's a very large gap there, almost 2x. But until those earnings squiggles start to sort of erode, I think this train could continue. But for 2025, this is obviously one of the big questions. One is inflation. Right. Will it reaccelerate because that dragon has not been completely slayed? And the other one is if the market continues to broaden, but in a disorderly way, by the Mag 7 going down rather than going up less than the rest of the market, that's another sort of big question mark without an answer at this point.
Mm-hmm. And just that 38 times earnings fully justified is sort of a wow.
There's no free lunch, right? There's no free lunch. If you want the big growers, you're going to have to pay for them, and that's kind of the story.
That's kind of the story. That's what they cost. We'll come back to equities for sure, but just a quick note to what Treasury yields have done. This has had a lot to do, obviously, with the Fed, but the Treasury yield story has been wild. We've had these cuts. You've had yields still sort of stay where they are, with concerns, we assume, of maybe some inflation in the background, or at least worries of it. Let's go there to the 10-year.
Yeah, so it's slide 24. So my outlook a year ago was that yields would be in a range of 4 to 5%, and actually that was a good call, and that investors would be focusing their attention on the term premium, which is sort of happening as well. But I'm actually surprised that it's not higher than it is. It's only about 20 basis points or so. And so I continue to think that, treasuries will be sort of in this 4 to 5 range, but with more upside than downside potential for yields, not for bond prices, because we are looking at a fiscal regime that no matter who would have won in November would have been expansionary, just because of the way our fiscal house is put together, right? You look at defense spending, entitlements, and debt service, and that's like 75% of the budget. And so there really isn't much to cut. So this whole thing about the Department of Government Efficiency, I think it's great that Elon and Vivek are looking at that, but I don't know how much teeth it will have. So the idea of fiscal discipline, the incoming Treasury Secretary has these three arrow type thing, and one of them is deficit at 3% of GDP. I think that would be great, of course, but I think GDP would have to grow a lot for that to happen, because right now the deficit's about 6 or 7%. So the term premium remains a question mark. Historically, the term premium is positive, as it should be, right? It's a risk premium. Risk premium should always be positive. But in the last couple of decades, it's been negative, as you can see in the bottom panel here, because of the heavy hand of zero interest rates, negative yielding debt, quantitative easing. That heavy hand from the central banks, not just the Fed but others, suppresses risk premium. I mean, that is what it's designed to do. And so that heavy hand is now largely gone. And unless it returns, I can see the term premium go up. And just like one basic rule of thumb is the 10-year Treasury should trade more or less in line with nominal GDP, right? So that's real GDP plus inflation. It's around like the 5-year growth rate in nominal GDP in the US is about 5%. So that tells you that the 10-year should be at least 5%, but that's assuming a normal risk premium. And I think that's where we're heading in the future. And I think for the most part, the economy will be okay with that. But, it does keep the mortgage market expensive for homeowners to buy property. And I do think that the Fed model, which we've discussed over the year, that occasionally you're going to get a tantrum, like we've seen in the UK from time to time, where the bond market gets sloppy because it's deficits forever, right? And extending the tax cuts, which of course is part of President Trump's plan, from what I hear, it's going to add another $5 trillion to the debt, and so that has to be financed some way. And maybe the Fed will entice the banks or regulate the banks into doing its heavy lifting for it. I mean, that certainly is plausible. It's happened before during World War II. So the Fed doesn't.
What do you mean by that? Like just to boost lending?
No, the Fed could change reserve requirements, for instance. Like it could say on like repos, for instance, which is the program has gone down, but it could say we're not paying any interest on it, and we're going to charge you a 40% reserve requirement. Then all of a sudden, that's a lot of money that's now sitting in the government that can be used to mop up the debt. So there are things that the government can do.
Tell us a little bit about this story of cash on the sidelines and what it means for equity markets going into next year. We often hear about the mountain and whether it's still saving or still sitting on the sidelines, and whether money markets funds are just going to be the recipients ongoing, because rates, actually haven't moved that much in a way.
No. So that's slide 5, and I see this all the time. People referring to the mountain of cash, and it's only a matter of time before that finds its way into the stock market. And it's possible, but the way I look at the mountain of cash, money market fund assets, which is about $7 trillion in the U.S., it's gone up, but so has the value of the stock market, right? So the way to look at it is as a ratio, which is the gray line at the top. And the ratio of cash and money market funds over the valuation or the market capitalization of the stock market is about average, about 10.5%, which is where it's been. And when you have panics like we saw in 2020, you see that big spike there. That's what a flight to quality panic looks like. We never got that in 22, for instance. And so, in my view, this money is mostly just a byproduct of the little banking crisis we saw a year and a half ago,
Right.
where people weren't quite sure if their money was safe in these smaller regional banks, Silicon Valley Bank, First Republic. And part of it is just the fact that banks are paying on average 0.5% on the balances in checking accounts. And money markets are, they were 10x that. Now they're maybe 8x that, but that's still a lot.
Still
So I
okay. Yeah.
think, yeah, so I think that this money is, no pun intended, it's on loan from the banks, if you
Okay.
will.
Yeah.
But having said all that, if you look at the orange line, that's the high yield credit spread. And as you can see, the gray line and the orange line are highly correlated for obvious reasons, right?
Mhm.
Because it's a fear index. So when spreads go up, people are afraid, they put money in cash, they take it out of the stock market. And that orange line is about 1.5% lower. Sorry, the gray line is 1.5% higher than what the credit spread suggests. So that's about 1.5 trillion of cash. So if this is a mountain of cash, the mountain is about 1.5 trillion, but not 7 trillion.
Okay. Really interesting. Has high yield, no, I won't say run its course, but like it's had a monster time over the last few months. Is there more?
Yes, it's been a great asset class, much better than treasuries, of course. But, at 250 basis points, this is for high yield bonds.
Yeah.
That's a pretty tight spread. It's among the tightest ever recorded. Now, the economy is fine, defaults are low. The wall of maturities that certainly I was worried about a few years ago as rates went up, that gets pushed back. These companies are refinancing, they have refinanced their debt and they've extended their maturity. So the wall of maturities is like 2027, maybe 26. So it's not an imminent, danger of any sort. And so these spreads, they act like the VIX, right? The
Right.
volatility
Huh.
index. So they generally just sit around, do nothing, and you clip your coupons. And when they go up a lot, relatively briefly. And so if you're an investor and you want to be short, high yield debt or not in it, you're kind of betting on something happening that happens very suddenly, when you least expect it. And so, but the value is not what it was before, of course.
There's some great questions rolling in. There's a couple I might just punt to the end just because I want you to finish with some of your outlook for 2025. But this is a great one on earnings. Kind of goes back to what you were saying on earnings. Do we not consider higher earnings expected? Do we not consider higher earnings expected from the economy's growth to counteract the effect of tariffs? I mean, that's certainly one postulation.
Yes, the tariffs question is a very nuanced one, right? Because you think tariffs, the first thing that comes to mind is, okay, importers into the U.S. are going to pay more for their imports, and they either have to pass it on to the consumer or they have to eat it, and their profit margin erodes. But that those things are true, of course, all else being equal. But of course, all else is hardly ever equal. So offsetting that, for instance, is a stronger dollar, or like in the case of China, maybe a weaker yuan. Now, there's rumblings out of China that they're going to maybe devalue, and certainly the dollar has been strong. You all know about that in Canada.
Yes,
So
we do.
if you're a U.S. company importing something out of Canada or China, and that currency is weakening, that offsets the increased price that you're paying through tariffs, or at least it could partially. So there's all kinds of offsetting nuances, and I think those are good to keep in mind. And again, the hope is that tariffs are really just a negotiating tool, a big stick that the president carries around as he calls meetings with heads of state. And he's making deals, and he wants to have deals to be as favorable as possible. And I think there's a view in the administration that the rest of the world has taken the U.S. for a ride for all these decades, which I think is probably overstating things. But I think this is sort of mercantilism, and may the best negotiator win, I guess. But so there are definitely different angles to the tariff story.
Right, absolutely. Yeah, no, it's a fascinating area that we will be talking about for years, it looks like, years to come for sure. Another question, this is on Japan. Thoughts on the yen, the carry trade with Japan, so kind of digging back into that story of the currency differentials.
Yeah, so in July, and do I have a dollar
Yeah, in
chart?
early August, that was a wild
Yeah,
time.
yeah, I don't have a dollar chart, but yeah, so currencies, trade on interest rate differentials, of course, and you know that. I mean, the Bank of Canada just eased again by 50 basis points, and generally nobody wants a strong currency, but it's sort of kind of part of the Trump story that he wants a strong dollar, but I don't really know if that's actually the case or not. But so, currencies are driven by capital flows, by interest rate differentials, and not only differentials between the US and, for instance, Japan, which, as you mentioned in August, caused quite a stir in the markets. I mean, I think the Nikkei was down
It was a
12%.
shock to the markets, there's no question.
And it unraveled the yen carry trade, which actually was all sitting in the Mag 7. So that was a very interesting taste of what a disorderly broadening could bring, right? Because it was the Mag 7 being sold off because this is where that levered money was sitting, right? These are like investment tourists, right? They're renting those stocks as opposed to owning them. And so we saw the market get unsettled, but then the yen carry trade appeared to be over, and the market, of course, has come back. So it is the differentials between different countries, and one of the stories I think for 2025 could be that if inflation proves to be even stickier than it has already been this year, and we're looking at a three handle, a 3.5 on inflation, and that causes the Fed to ease less or not ease at all, or maybe even tighten at some point again, that's likely to boost the dollar because the rest of the world is not in that same position, right? And so the differential between different countries matters, but also between what is expected from the Fed versus what the Fed is currently doing. That has a large impact on the dollar as well. And I think that is an ongoing story for next year.
Does all things being equal, which as you say is never the case, does Canada get dragged along with US growth if that's what happens? Even if there are going to be bumps on the tariff story?
It should. I mean, I think kind of this America first mercantilism, which I think clearly is part of the Trump, playbook. I mean, we import a lot from you all, and Mexico plays a very large role as well. So I see it more as a North American super bloc. And I think, I don't think in the administration's eyes, Canada and Mexico are the enemies. It really is more China. And I think rerouting supply chains, not just to the US, but to North America, and making sure that, like, for instance, China doesn't dump products in the US via Mexico, like via sort of the back door, if you will. I think that hopefully cooler heads prevail enough that will be the case.
So just to sort of finish out, two risks. Inflation is one that you've noted, and the other is just, a serious devaluation of the Mag 7 that could kind of drag the rest of the market down with it. You've mentioned both of those and gone into detail. Just, if you don't mind, finish off with sort of the place of a 60-40 right now, right here, with maybe an inflation risk.
Yeah, so slide 28, and this is not investment advice. I just want to be out there. So this is not some highly optimized portfolio. You should not copy this. But on the left is the regular
I'm just
old
going to put up
60.
the right. Oh, there we go. Yep.
Yeah, and on the right is sort of my vision of what a post 60-40 portfolio could look like. So equity still the backbone, of course. I mean, that's where the compounding happens. But fewer bonds. Bonds have value on a nominal basis, on a real basis. Their real yield is positive, but they are no longer negatively correlated with stocks. And that could change, of course, but right now they're not. And so they're not going to protect us necessarily when stocks go down. So if we lose that negative correlation, what do we do instead? There really aren't other asset classes that are very negatively correlated, other than gold. And
There's a
the
question
U.S.
here about Bitcoin, but
Yeah, and the U.S. dollar as a currency is very negatively correlated to risk, to a risk-on stance. But so the way I look at it is you sprinkle in a bunch of things that really were never needed back in the regular 60/40 world. Like you needed just those two indices, S&P and investment grade bonds, and you could call it a day. And if you got really clever about it, you probably lost return in the process. But now alternatives, managed futures, gold, Bitcoin. I see Bitcoin as an alternative. I think those can all be sprinkled in, and even some cash, right? If we're in a new era of higher interest rates, then cash actually has some value. I mean, cash doesn't compound, so you don't want to have a lot of it. But that's sort of how I think about the post 60/40 world. You want to sort of paint the market with a broader brush.
Okay, it's wonderful to see you. Thank you for telling us all about this amazing report, looking back and looking forward. Delighted to see you, and all the best for the holidays.
Thank you. Same to you, and same to everyone watching.
Jurrien.